Hey, everybody. Welcome to the morning market briefing. It's Monday, May 18th, 2026. Hope you're doing well. Hope you had a good weekend. We got super producer Hicks back from New York. He really set the town on fire, it sounds like. So glad to have him back in the saddle. M&A is back, boys. NextEra. Thinking about buying Dominion Energy. Just a cool $66 billion deal, mostly in stock. Ben, what's the angle?
This would be the biggest power deal ever. NextEra would give 0.8 shares of NextEra for every share of Dominion, valuing the company at about $76 a share. It closed Friday at about $61 a share, so a nice premium for those shareholders, although I imagine that NextEra would fall if this deal actually was going to come through. Pre-market, NextEra is down about 2 or 3%, and Dominion's up about 11 or 12%.
Yeah,
so
D up to $69.
Yep. So I mean, I think at the end of the day, this solidifies a lot of what David Solomon on Goldman Sachs Q1 conference call talked about, because he was asked, is the M&A market slowing down because of interest rates and oil prices? And he said, maybe there was for a week.
Yeah.
But by and large, a lot of companies are seeing this as a really good M&A opportunity, in part because of the regulatory environment, which they think is a little bit less onerous or certainly more clear than the previous administration. But secondly, the valuations are somewhat attractive. There's obviously higher power demand, so in this segment specifically, it's attractive. But even beyond all that, a lot of companies are viewing the potential of combining entities as much less difficult a task than combining entities before AI, because what you can do is you can stitch together ERP systems much, much, much faster and more easily. So all of a sudden, M&A that seemed very daunting and cumbersome is becoming a lot more manageable. And certainly for the executives, they think, well, AI can just knit it together. And to some extent, they're right. I think.
Yeah, it's going to be interesting, I think, to see the postmortems on some of these deals, because, I mean, historically, we've always kind of rolled our eyes at some of the synergies that are alleged that will be, conceived out of, you'll see a deal get done and they'll say, oh, we think this unlocks $30 billion of synergies over the next 15 years. Mm-hmm. And you never really get a thorough rewrite on those, and you never really necessarily know if those synergies were achieved. It seems like if you're saying, hey, part of why these deals can get done more easily is that the AI is going to work, is we should see some real success stories.
Yep. And Dominion's a fairly hot commodity anyway because of its location in Virginia and its ability to provide power to a lot of these data centers in that area. So I think that's an attractive target for NextEra, and I think to some extent makes sense. But we're seeing this throughout. We're seeing this, even the RIA space, I think a lot of people are very excited about what AI can do in terms of bringing systems together and quickly onboarding a large number of clients onto their platform. So I think this is not just in utilities, not just in different spheres, but it's kind of ubiquitous. It's giving people an opportunity to see, really to see opportunities that they might not have seen before.
Do you think there's going to be, utilities are obviously regulated differently, oftentimes just because of the geographic piece where, Southern Company can only raise prices by so much because they have a geographic monopoly. But if you look at the market caps, NextEra is about $200 billion. The next three, Southern Company, Constellation, and Duke, are all roughly $100 billion. You basically have one utility company that's nearly the size of the next three largest ones. You think there's any pushback on that, or they might have to divest pieces to make it work?
I think that we'll see. In certain areas, I think the states will just be amenable to it and just might not challenge it. I think if you saw Constellation would be an interesting one, because I think they're the ones up in New York with 3 Mile Island. And so I think the regulatory burden on that might be a little bit more difficult. But certainly in the South with NextEra, Dominion, I feel like that'll probably go through. Or if there were any in Texas that would be deconsolidated. I know we're talking about regulated and unregulated. I also think there's a huge, and we talked about the wealth management space, but I think in banking, people have been talking about this wave of bank M&A activity that is pending for the last 20 years since the global financial crisis. There's always been community banks are going to get rolled up into regional banks are going to get rolled up to the big players. And I think this, again, makes it so much easier to attract, all of a sudden, get deposits simply by rolling in a community bank. And overnight, you can have a bigger bank.
Yeah, the banking space is interesting to me because you hear two really conflicting narratives. Well, you hear one and you see one. You hear the number of banks has gone down, tremendously, and there's certainly data that suggests that. And yet, I feel like every time I drive, there's a new bank. Mm-hmm. and I mean, even just in this immediate area, and not specifically through acquisition, the number of banks that have come in and gotten a pretty strong foothold in Marietta or Cobb County that didn't exist 10 years ago is pretty impressive.
And I think the M&A on that is so, I mean, just simply, hey, you and I would be better together. Let's combine. We'll do it at book value. We'll split the shares accordingly. And all of a sudden, now we have a bigger base off of which to work, because half of these banks I've never even heard of that are just local. I don't know how they can build the awareness to really get scale and build deposits and lending activity.
I mean, that one on the top of the square has changed hands like 3 times.
Yep.
I think it's a South State now.
Yeah,
but
South
it's
State.
like even in the last 5 years, they've changed that sign.
Yeah,
a
so many
handful of
times.
Yeah.
And not just here in the U.S., UK deal making up 250%.
Yeah, up to $150 billion, the biggest since 2015. Lower valuations. They do have some political instability. We've talked about that in the UK. But I mean, you've seen a bunch of stuff go on because it's well regulated. Their earnings quality is good. Some of these international companies, and one of the reasons that we generally shy away from international is because earnings quality is terrible. You don't know exactly what they're reporting. They're not regulated, obviously, in most cases by the SEC, because they're in different countries, and they can do different things with their accounting than we're used to. But the UK is generally actually very good about that. If there's one country, I was talking to my wife about this over the weekend, but if there's one country that follows the rules, it's the UK. Everything is about a rule, and if you're not following the rule, minding the gap, what are you doing?
Wearing your wig in court.
Yes.
Still
wild. Every time, once a year, I get just absolutely flabbergasted at a clip from the court.
Yeah, you got to wear a wig in court. It's absolutely insane.
So we're seeing a lot of companies look at UK companies as opportunities for growth. We saw McCormick buying Unilever's food business, Schroeder's asset management and selling out to Nuveen. Tate & Lyle was just a story from last week. They're the big ingredients manufacturer. They're seeing interest in one company who we own, Sunbelt, was formerly listed on the London Stock Exchange, now on the New York Stock Exchange, is now formerly Ashtead, now Sunbelt. So I think we're continuing to see companies try to generate the best value for the shareholders, which is good to see. And some of that's coming in M&A, some of that's coming in being selective about where you pick up M&A, and that's all good for the investment banks.
Yep. Tom, quite a bond sell-off on Friday. Continued concerns about re-escalation of tensions with Iran, at least seems to be the headline that's driving this, but we saw the 10-year hit over the 4.63 mark, 30-year hitting 5.13, mortgage rates inching closer to 7%, kind of at a 6.75 right now. Has anything changed in terms of your outlook on the rate picture? Because we're now seemingly pricing in a rate hike.
I mean, I think that would be extremely unwise. But I think if you go back and listen to all of our calls the last couple of years, the expectation markets have been consistently wrong, and they swing wildly based on what's currently happening, not what reality is.
They're incredibly emotional.
I mean, I think at one point last year we were up to like 7 cuts for this year, and now we're at a hike. And so if you made those bets last year, you would have been off by, over 2%. So I think that we need to be cautious about what could happen in the next 3-4 months. I think that if there's not a resolution in Iran, I think that people will settle in and that inflation will settle in as well. And if the higher oil prices equate to higher gasoline and fertilizer prices, then that's going to eat up demand for other stuff. And I think that we'll see inflation throttle because, I mean, Ben said a great chart, and I don't know if it's in the notes or not. The real places we see inflation are really everything that the government touches. And you could argue that that's even the gasoline markets at this point, which is that, you start doing rent interventions, you start to see rent spiral. You start to do healthcare interventions, think Obamacare, you see that spiral. You start to see, the change in how you finance your college education and look at what college costs now versus what it did in 1990.
You start a war in the Middle East.
Yeah, and you have a government intervention in the Strait of Hormuz, and guess what? Prices start going up. But those are more structural, but a lot of those things involve having to print money in order to satisfy need. And so they're printing money to lend for student loans. They're printing money to pay for people's health care. They're printing money so that you don't have to pay your rent. The government will pay your rent. And so those things are really the main inflation drivers. If you start looking around at kind of other stuff, for the most part, you start to get prices coming down. I mean, think about what the price of a TV was in 1995 versus what it is now, and that's the function of, corporate execution and supply chain management and all these different things that have caused things to drop in price. I mean, think about a cell phone just in terms of what it is versus what it costs. I mean,
think about the brick cell phone that Gordon Gekko had in the 1980s and how much that cost and how rare it was because of how much it cost and how limited it was to what we have now.
Yep. Yeah, and what it costs to talk on per minute. We don't talk about minutes
it was
or roaming at all anymore.
You used to pay for 100 text messages a month.
So the idea that we're not going to innovate and find ways to bring prices down on most goods over time, I think is silly, and I think that we're really overreacting. And I think that the narrative has been the war in Iran is really causing rates to go up here. But if you look at the different charts around the world, and I've got up on my Bloomberg function WB, which is the world bonds sort of side by side. For the longest time, we talked about on this podcast how most rates on the planet were negative, and how the U.S. was the shining beacon on the hill, that we had positive rates, across the board, even on our 10-year, 30-year, when things got really, really tight. But what's really happened is the layer cake that is the rate stack across the world is everybody else is getting crushed. Japan is getting crushed. The United Kingdom, their 10-year is at a 5.10 right now. I joked about it a couple weeks ago. At what point do we start buying the gilt, which is what they call their treasuries? I mean, they've just rocketed by us, and they're at standard deviations above the mean, higher than they've been. And that's because there are other places in the world that are getting hurt way more by the war in Iran. And we've talked about that too, where it's just Japan can't get enough oil and their prices are going to go through the roof. UK, another island country, having a hard time getting oil. And that's a real problem for them. And what it does is bonds are a relative value game. It's all about how much is this worth versus that. Are mortgages cheaper than treasuries? Are treasuries cheaper than munis? Is high yield cheaper than IG corporates? And how does that all relate to each other in that credit stack? And sovereigns are like that as well. So as soon as you see the most expensive sovereign debt become the cheapest, there's going to be a huge shakeup. And I think that's really more of what we're seeing. Is you're seeing real panic in other bond markets, and that's causing general panic in bond markets. But again, I reserve the right to be wrong on this trade, but the 30-year is actually a safer place to be, in the 20-year as well. Is that if you look at the relative change on the 2s, 5s, 7s, 10s, the meat of the curve, the belly as they call it, has gotten crushed. I mean, 3s, 7s, 5s, 10s are all down significantly on a yield basis, right? On a price basis and a yield going up basis, far more than the 30-year. So you're actually insulated by having more duration here, because the yield curve is starting to look like a yield hump, and the reason that is because instead of being a curved line, the middle is inflating up in the center, and you're seeing a lot more principal loss there. That being said, munis are holding in tight, mortgages are getting pummeled, and I think it's just an unbelievable opportunity akin to 2022 when we could just buy mortgages all day long and they outperform for the next 3 years. I think it's another time to start locking those in. But I think that it's really a global rate story and not necessarily U.S. inflation is spiraling out of control. Because if you look at it, we basically kind of been in a sideways with, low peaks between 5 and, call it 430 on the 30-year for 2-3 years now. You look at Britain, they haven't seen this ever. They're going straight vertical. Japan is going straight vertical on that chart. I mean, they're getting absolutely elevator down on their bond prices, and that's causing a lot of demand shift because now suddenly, talk about relative value, you could make more money if you live in the UK buying a UK 10-year gilt versus buying a 10-year treasury. And that was always the thing is like people are going to buy, the Japanese are always going to buy the US 10-year because it's cheaper than the Japanese 10-year. That might not always be the case now. And so some of the demand shift is going to other countries. And I think that's worth noting, but it's causing some real
And you see that show up
gyrations.
especially on some of the auctions.
Yeah.
Where it's like, I think also, you mentioned this, the relative value component of fixed income management is lost on a lot of people. The other piece is much more so than the stock market. It is a game of supply and demand. And if there is the same amount of supply, but there is more demand for a gilt because it pays more, guess where the money's going?
Yeah. I mean, it's, like in theory, there are only so many shares of Apple, but they trade so frequently that you can always buy a share of Apple. That's not the case for bonds.
I think the UK Labour government, I think, is not long for this year. We'll see what ends up happening with that, but Keir Starmer's kind of lost it. If you're thinking, when I think about the UK, I think about they're really strong in insurance. Well, what do insurance companies do? They invest in bonds. And if their bonds are getting smashed, I do wonder if we should be on the lookout for a
Lloyd's
UK
of London
becoming a Silicon Valley bank. Maybe not Lloyd's, but maybe something. And it would start low, but it's something to be watchful.
To your point about we always talk poorly on European stocks. For my entire career, they've been like, man, European banks, specifically British banks, are so cheap. They're trading at 9 times earnings, and I guarantee you right now they're trading at 3 times earnings because they're getting crushed.
And by the way, all the mortgages are floating.
Yeah, and that's a real structural problem in the UK is that they have that baseline rate that your mortgage goes on. I mean, they're getting killed right now, and that's going to lead to, serious austerity measures because the British move is the stiff upper lip to, keep calm and carry on, but that's going to be difficult. They did it. They did it during COVID. They're going to do it now, where they take the most self-flagellatory stance, which is like, I'm just going to grit my teeth and get through this. But we don't do that over here. But, I think that they've navigated their rate environment more effectively than we did. But now they're in a real tough spot because we sort of inflicted some problems on them.
Yeah.
So sorry about it.
I'm not.
Not really. Yeah.
Reports of an Iranian drone strike in the UAE. Perhaps some uncertainty as to where it originated from, but certainly it seems that the official line is that it was from Iran, came over the western border. I'm curious, Ben, this is not in the notes, but we seem to have collectively accepted re-escalation. Like that was coming. I think a lot of people were looking for something over the weekend.
I was refreshing like crazy.
What do you point to that has driven us to that point other than the fact that it's just kept dragging on and nothing's like it? Is it just because I look at what Trump has talked about, I look at things that have been said. To me, the tone hasn't shifted. To me, it seems, and I don't want to defend the status quo that we have been in for the last several weeks because I certainly would say that's untenable and unsustainable and non-productive and not really accomplishing anything. But is the general, I don't want to say appetite as if people are wishing for it, but the appetite of acceptance of re-escalation, is that just a byproduct of boredom and fatigue and nothing's happened?
I think it's a couple things. So I listen to a lot of Two-Way, that podcast we listen to, precisely to understand why this is happening. And I think that there have been the Republican Party is kind of bifurcated into a group that both groups want this escapade, this excursion, as Trump would say, to end. One thinks that the only way it will end is with devastating force, boots on the ground, something that we haven't seen before yet in Iran. The other is we just need to leave. And either way, the middle course is viewed as untenable. But I think that right now, Trump is undecided. And I think that middle course is the status quo for now. And I think that people are anxious. it's kind of that suspended chord. You know, you finish the song finishes, and yet it doesn't finish on the tonic key. It doesn't finish on that resolution note. And I think that that's where we are in Iran. And I think that everyone feels that tension about something's got to change. I don't know what it's going to change. We just got to do something. And I think that then feeds into the market. And then there was this narrative in the market. I don't know who perpetrated it, but the narrative was on Friday that now that Trump's done with China, it's
back to war.
It's back to war. And
and that's the piece that I've really struggled connecting the dots on, because I think you're right. I think the status quo, typically you might view that as certain and dependable, but the reality is everybody kind of recognizes the status quo as this middle ground, and so got to go break one way or the other. It's just interesting to me that we've jumped to it's going to break this specific way.
I agree, and I think the market kind of dictated a lot of that. It's weird how the market can create a headline. But I think the fact that the market was down 1.5% on Friday kind of wrote a lot of those headlines. And then what are you going to – because no one knew why the market was down.
Yeah.
And so they'll write a headline, the market falls as fears of Iran escalation rise again. It's just commenting on what's happening because people need a reason.
Yep.
But it doesn't mean that anyone has any insight as to whether that will happen or not.
I want to wrap the call up with some AI charts. I'll give Hicks a minute to pull those up. Previewing the week, tomorrow we've got Home Depot. We will get NVIDIA earnings later in the week. There's a 20-year auction. Plenty of coming through. It's a nice balanced news week as we look at the table here on Monday. We previewed some of this stuff last week. But let's wrap up here with some AI charts that you saw over the weekend, Ben.
Yeah, I mean, I guess the two we'll just kind of hit two because we might be going a little bit long. But the first is just the capital intensity of the new AI reality, and this is annual capex to sales. Hicks, if we can get that up, and you can just see absolutely going off a rocket ship. Companies that used to spend 10, 15, 20% of their revenue on CapEx, they're now spending over 50%. That is a lot considering these companies make excellent gross margins, kind of in the 40, 50, 60, maybe even 70% range. But that's up before all operating expenses. And now you got CapEx that's over 50%. So a lot of these companies aren't going to be free cash flow positive, including Microsoft, which is just unbelievable considering that they generate over $200 billion in cash flow a year. And now that's just going to be funneled toward CapEx. But you are seeing an inflection higher in usage. If we can get to the unprecedented growth chart, Anthropic taking off. OpenAI, I think, this chart isn't updated for OpenAI, but we're seeing that move higher as well. And so I do think that we're seeing the revenue cases for AI, but people don't know exactly how that's going to square. I just think this is interesting in terms of the changing nature of these big mega cap companies and the aggressive adoption of AI. And I think actually let's go to the last one.
Chart.
No one knows anything. It's kind of and I think this is so true. We had the internet, then we had mobile, now we have Gen AI, and what ends up happening is that a lot of the things that we see today don't actually exist in 10, 15, 20 years. I mean, when was the last time you were on AOL Instant Messenger?
Or used your BlackBerry?
Yeah.
I wish. I wish it was every day.
Man.
Netscape.
Netscape. That was the truth.
Remember BlackBerry, Research in Motion?
Yep.
I was trying to explain Prodigy to the young boys, like the very first version of the internet.
Yeah.
We had it. I used to play Sesame Street games on it, which is that's how long ago we had a very early dial-up situation, and it was in green because we didn't have a VGA card.
I mean, it was everyone's on their BlackBerry.
I mean, dial up.
Obama has his BlackBerry. Yeah.
Man, you got mail.
Yeah, good old days. Yeah, it's something to be mindful of. I mean, things that seem, impossibly overwhelming as a trend, many of them won't exist.
Mm-hmm.
And that's not a new phenomenon. Perhaps it's a new application of the same phenomenon, but nobody knows anything. And on that note, we'll wrap it up there. Be back tomorrow. Y'all have a great day.